Wall Street, our parents, the education system, the American dream, everything has taught us that the path to retirement was basically, one way. But as I know you guys know, the real path to building generational wealth and, is through real estate.
Welcome to the Peak Profits Podcast, your guide to maximizing returns in passive real estate investing. Hosted by Brian Morris and Chris Ward of 7 Peak Capital, we dive into conversations with industry experts, sharing insights, strategies, and stories to elevate your investment portfolio. Whether you're a seasoned investor or just starting out, this podcast is designed to give you the edge for financial freedom. Get ready to unlock new opportunities, discover the secrets of successful investing, and take your passive real estate investments to the next level. Now, let's go reach those peak profits together.
Welcome back to another episode of Peak Profits. Today, we sit down with Brian Heller, the founder and CEO of Fairway Equities. Fairway Equities specializes in acquiring underperforming B and C class apartment buildings in high growth markets, turning them into profitable investments through strategic renovations and optimized property operations. Brian, welcome to the show. We're excited to have you on the podcast and can't wait to dig into your story and share with our listeners how being an LP in other syndications has helped you become a better GP for your investors.
Yes, thanks for joining us. We would love for you to introduce yourself, tell us a little bit more about Fairway Equities, and share essentially, how you transitioned in from entertainment into real estate.
Absolutely. Yeah. Thanks for having me, guys. So I'm the founder and CEO of Fairway Equities. Fairway Equities is a dynamic real estate investment firm that specializes in value-add apartment buildings. And we help busy professionals and entrepreneurs to passively invest in multifamily real estate. Our real goal is to help anyone build generational wealth and a life of unlimited freedom without the management hassles of tenants, termites, and toilets. And, as you mentioned, I started off my career in the entertainment industry. I went to USC as a cinema television major and, worked in the television industry for 10 years. I did the Dashboard Confessional video where we won MTV2 Video of the Year. I worked on, Survivor, The Bachelor, Ripley's Believe It or Not. I've, blown up mountains. I've traveled the world, gotten to have some really great experiences, in my 20s, and certainly something that I really enjoyed doing. But over time, I became frustrated with the on again, off again nature of the entertainment industry and all of the travel. I almost missed my best friend's wedding, and just really having control of your life and your schedule is something that's very difficult when you're traveling, when you're working 80-hour weeks. And so ultimately I realized that I really wasn't building anything. And so I decided, after a good amount of research, to get into the, multifamily business by becoming a broker in Los Angeles. And so, did that for about 8 years, did about 200 million in transactions, and ultimately decided that I wanted to get more onto the principal side of things. And so I moved to Nashville, where I've done everything from building houses to entitling land to ultimately getting into apartment syndication, and have recently completed one full cycle deal, and are aggressively looking for our next opportunity as we speak.
That's awesome. And I know you mentioned USC. Are you a big Trojans fan following football still to these days?
I'm a huge football fan. Yeah. So I was an 18-year season ticket holder, and I was there for all the glory years. So, well, technically the 4 years I was in school were our worst 4 years in team history, but Carson Palmer was a freshman when I was a freshman. And the first game I ever went to, Drew Brees started for Purdue. But I've saw all the good, the Reggie Bush stuff, the Leinart stuff. It was, I was at the Andrew Luck triple overtime game, even though we lost that. But, lots of great memories with USC football. So yes, you're talking to a diehard for sure.
That's awesome. I figured that so much. I'd like to touch quickly on college. What did you go to college for? I know obviously you went into the entertainment industry, so there probably wasn't much on your mind about getting into real estate in college. And then you made that transition after. And I know I did the same, similar career path, going to college for business and transitioned to real estate a little bit later, upon graduation, about 4 or 5 years afterwards. So can you talk a little bit about that transition from that entertainment industry and then getting your brokerage license and what really made that shift for you?
Yeah, so I had a friend that very similarly worked in the entertainment industry. He was more on the agency side of things, but same thing, frustrated with the hours and treatment and all that kind of stuff. And he ultimately got into real estate. And he's like, Brian, there's so many crossovers between entertainment and real estate and the skill sets. He's like, I think you'd be really, really good at it. And so I ultimately decided to start out in brokerage, which I think is a really great place to start. I would highly recommend it to anybody in that, because you really you learn markets, you learn how to underwrite, you learn how to do the value add and everything from, talking with your clients and helping them to formulate a business plan and learning to read rent comps and all that good stuff. And so, that was kind of my original foray, and transition was in regards to that.
That's awesome. So you mentioned value add there, and I know that's been your primary focus since transitioning. So can you kind of explain to us, what motivated you to focus on the value add aspect of it, the apartment buildings, particularly Class B and C properties, and go into a little bit more detail with that?
Yeah, well, obviously, if you have the money to buy a huge deal, by yourself, then you can do a lot of different things. But if you're like most of us and you don't have the money to buy larger deals on your own, in order to be able to bring capital partners or investors, or whatever, and offer them a compelling return in a deal, then you have to be able to force appreciation by adding value. Not to mention, really, most of the clients that I was dealing with and most investors are, looking for ways to vastly improve a property. The pension funds of the world can go by the main and main and just sit back and kind of clip a coupon, knowing that the location alone will, kind of take care of the rest. And they're looking for really slow and steady. But, investors, like I said, expect a return and, wanting to not only, deliver returns for them, but, another thing that really, I think, attracts me about B and C properties is this opportunity to go in, improve the community or improving people's homes. It's a good feeling knowing that you've made someone's life and their living situation, their environment, better and more enjoyable. And in some cases, like I said, improve the community and all that good stuff. So that's another reason why as well.
When you're talking about improving communities and improving the way that people ultimately live their lives, which is a big task in itself to undertake that. So how do you go through that process of identifying the underperforming properties and ultimately transforming them into profitable investments?
Yeah, so identifying underperforming properties and transforming them into profitable investments, there's a lot of different things you can look for. Certainly, sometimes the numbers will show it, but oftentimes by visiting the property or going on a property tour, you can see deferred maintenance, or from the photos in a marketing package, you can see the outdated cosmetics. The numbers might show bad management, high vacancy, things like that. And then in terms of, transforming them, you've got opportunities, obviously, in terms of the standard value add, just improving the unit interiors, deferring or curing the deferred maintenance, things like roofs, potentially rebranding the property, improving the overall curb appeal, obviously adding professional management, potentially if the property is currently owned by a mom and pop or someone out of state, having the ability to have boots on the ground, or in this day and age, even just adding things, adding technology aspects, whether that's helping out in terms of leasing and things like that with AI, smart thermostats, or they have like things that now can track different utility usages and things like that to really help to curb expenses and things like that. So there are a number of opportunities, not only to identify, but also to transform a lot of these properties.
That sounds like a lot of work there, Brian. That's not just something that one single person can do all of that. So why real estate versus other investment vehicles, right? Like that doesn't just sound like anybody can get up and start managing properties. There's technology, there's improving units, construction potentially. Like, so why real estate versus others?
Well, I mean, real estate's tried and true, right? Andrew Carnegie's famous for saying that, 90% of all millionaires became so through owning real estate. And I think, guys like you and me are aware of that. I think a lot of other people, may or may not be. But, um, for me personally, a lot of it, came out of like the last time I really made money in stocks was back in the .com boom. And, but once I got into real estate, I tripled my net worth in the last cycle, all from real estate investments and from moving from a high cost market of Los Angeles to an affordable market like Nashville and being able to afford real estate and take advantage of it. With the 15 years experience, like I said, I've seen my clients, when I was a broker, do it over and over again. And I've had my own experiences and from the communities and masterminds I'm in, I really just have seen the power of real estate. Another thing, I actually got this from somebody else, but I thought it was an interesting point to share here. So in real estate, for lack of better terms, insider trading is legal. And by that, I mean, if you know a market or location better than others or anyone else, and for example, a train is coming down the street, or a new Walmart's getting built here, and you can buy up the land or other properties nearby, before the press release happens or before most people know about it, then you can get ahead of that wave and you can profit from that information, right? But if you do that in stocks, you'll end up in Camp Cupcake like some other people we know, right? So it's like I said, like in stocks, it's illegal. So but yeah, those are all some good reasons.
That's awesome. I want to take a step back and ask you about your transition from being a broker into what was your first real estate investment that you took on yourself. So can you talk us through investing, whether it was as an LP, whether it was in single family homes, whether it was a small multifamily? Can you talk us through that first investment and kind of your process as an investor up to now?
Yeah. So, well, technically the first piece of real estate I bought was the house that I live in, and eventually we'll move out of here and be able to rent it out for like $1,000, in cash flow a month. It's right across the street from a brand new high school and things like that. So that's part of the reason we looked at doing that. But the first investment property I bought was a duplex. And, it's very close by to my house, 2 townhome units, has zoning that ultimately so here in Nashville, we have zoning that allows you to like tear down 1 and build 2, kind of thing. Now this was already 2 units, but it has a zoning that I could ultimately tear it down and build 2 individual houses if I wanted to, because the lot's big enough and things like that. And then, I just got some really, really great financing. So, it was at a time when the market was really good. And so I only had to put 10% down. Normally when you buy an investment property, you need to put 25% down. So, this was a really great program, and I wish I bought several more, but, at the time I was also, building houses, and, my next investment is actually one of the houses that I built that I ended up keeping that I rent out, and that's, proved to be a great investment as well.
And so we've obviously known you for a little while now. We were discussing this at one of the conferences that we were at together, and you had mentioned that how being a limited partner in other people's syndications has really helped you become a better general partner. And we would really, really love for you to dig into that and your thought process behind moving from a limited partner ultimately into a general partner as well.
Yeah, for sure. This is a great topic. And so, yeah, let's definitely dive in. So, normally I would primarily invest in my own deals, because in every deal we do with, we like to put skin in the game so that our goals are aligned with our investors, right? So, but as you know, over the last couple of years, finding deals has been difficult and few and far between. So I had some money that I wanted to invest, and I realized I had actually never invested as an LP before. I had put my own money into my own deals, several times, But the more I kind of thought about it, I felt pretty strongly that, going through this process could really help me be a better GP for my investors, because, then I could say that I've walked in their shoes and gone through the same experience that they have. Right. And so, I'm really glad that I did it, because what I found, and it was really surprising to me, the psychology of being an LP for the first time, and the emotions that I felt, were just totally unexpected. Right. So especially considering that I have 15 years experience in real estate, I understand everything about real estate syndications, compared to, say, many of my investors, or, who work in fields outside of real estate. You would think for someone like me, it would be it'd be no brainer, especially since in this case, the deal was, pretty much a no brainer. So let's just start there, just to, just so everyone kind of gets an idea. But it's a 40 unit deal, historical trophy property in downtown Denver. Mom and pop seller. The GP team negotiated 2% interest only financing, and this is at a time when rates were 6 and 7%. So that was the real kicker right there, right? I mean, you had 3 years interest only, you knew you were going to kind of be able to bridge through, but 16 IRR, 2x, 7% cash on cash, very standard metrics that you would expect to see. So the lead syndicator I actually knew from my time as a broker in Los Angeles. He had purchased some of the deals that, that I had seen on the market, and things like that. And, and then also two of the co-GPs, I knew well, as well. And, from Jake and Gino, from our mastermind and whatnot. So, but, just like doing anything, for the first time, right, this fear set in. And even though that I knew that I wanted to invest in a syndication, I loved the deal, I trusted the operators, it was nerve wracking. To give some examples, I went back and forth on my investment amount. For me personally, I was concerned, since I hadn't visited the property and put eyes on it. I wasn't the one doing the due diligence on the property, and the list goes on, right? But as someone who worked in real estate, I think giving up that control or whatever was difficult, and really just going through the process for the first time, right? It's about overcoming that first time fear, those first time emotions. I think we all have a lot of walls of, tradition or whatever you want to call it, that we need to break through, right? Meaning, my generation, we've been raised to save for retirement, max out our IRAs, work with a financial advisor, and invest in stocks and bonds. You don't see, until recently, a lot of people weren't really kind of screaming from the rooftops, how important real estate was, right? That was something that for the most part, the ultra wealthy might have been involved in, but, your financial advisor certainly isn't talking about it. And people at cocktail parties usually aren't talking about it. They're just, talking about how good their 401ks did and all that good stuff. Right. So, like I said, it really hasn't been until recently that people started to realize there's a better way. Like I said, like Wall Street, our parents, the education system, the American dream, everything has taught us that the path to retirement was basically, one way. But as I know, you guys know, the real path to building generational wealth and, is through real estate. And so now that I've been an LP, I'm really glad that I did it. And since I invested in that first deal, which was a little over a year ago now, I actually just recently decided to take all of my IRA out of the stock market and move it into a self-directed IRA, so that I could use those funds to LP in some deals as well.
That's an awesome story. And I think it is a process that a lot of people go through, especially, as to your point, investing as a first time investor in any alternative investment. A lot of people understand today, like you mentioned, that they should have some type of real estate in their portfolio, but they're not exactly sure which avenue to go down or how to invest in real estate, if they have a full-time job. So when you first started evaluating GPs to invest in, how did you go about that process, and what were you looking for in the general partner team to make you feel comfortable that that first investment was the right one?
Well, like I mentioned, I knew, like, and trusted the team. The deal hit the metrics that I was looking for, but then when I actually dug in and sort of underwrote it myself, for lack of better terms, it seemed realistic, as someone who looks at a lot of deals, whether it be from brokers or, other people, whether to be invest or partner or whatever. I see a lot of times where the investment scenario has to be like perfect to hit their numbers, or they have an exit cap rate that, in my opinion, is very unconservative, right? That's a really easy way to make a deal pencil. If we move any deal to a 4.25 exit cap rate, it's going to work, right? But not very many markets, especially with where interest rates are now, are even close to that, right? But so that's for me, that was really it. I mean, liking being in a market that, a high growth market, obviously, right, rule number one of all real estate: location, location, location. So, good location, good team, realistic numbers, realistic business plan, and, and 2% interest only in the case of this first deal.
Yeah, that's an amazing deal, especially given where, obviously interest rates have gone since and where they're at today. And don't expect to see 2% anytime soon again, but hopefully we'll get there one day, maybe. But could you elaborate a little bit as an LP and a limited partner in a deal? What should investors who've never invested as an LP before into a real estate deal, what should they expect in regards to as communication, reports, updates on the property, right? Because you're now a partial owner of this property yourself as a limited partner. And so what can you expect to hear from the GP team, and what do those communications look like?
Yeah, I mean, well, that's actually probably one of the biggest things that I've learned, and one of the biggest takeaways that I've gotten is that, everyone's communication style is very different, but also how important that is, right? Because I mean, that is really the biggest thing. You've given these people your money, and all you can do is basically sit back and wait for them to let you know. And it's a fine line between communicating too much, not communicating enough. And it's also what do they want to hear? What do they want to see? And are we sending it to them, or are we just expecting them to go to the investor portal and know that it's there and things like that? But, what we provided our, investors with is, somewhere between monthly and quarterly. I think it sort of depends on the size of the deal and what's going on, right? Like, a larger deal, if you're turning a significant number of units, I'd probably expect a little bit more regular communication. If it's a smaller deal and, there's not quite as much movement, then, quarterly communications is good, but that's really what I've seen in general. So somewhere between, monthly and quarterly communications. Investor portals are getting better so that people can put the updates there. But I think it's important to also make sure to let your investors know that the update is there, which is a little bit of one of the problems I've had with one of the deals I'm in. They kind of put them there, but I don't feel like I always get communication that is there. But if I remember to go, then the information's there and it's good. So
it's interesting you talk, Brian, about kind of people just putting their money in and then very, very quickly expecting communications, updates, like regular communication, because it's not gone through the traditional approach of a 401k. But for a 401k, you essentially receive a monthly statement with little to not a great amount of detail in it. But the second you're wiring somebody potentially less funds than what's sat in your 401k, you're looking for more updates. But again, it is something that, like you said, every LP will expect things differently. So being transparent, providing those communications, letting your investors know that they just need to look into the investment portal and that's where they'll get it, or the distributions will be monthly, quarterly, etc., is obviously extremely key. You said that was one of the key things. Communication was one of the key things you learned being an LP. Is there anything else that you'll now adopt, or anything that you've actually since potentially changed in your approach as a GP?
Yeah. So this is actually great, kind of building off what you just said, is that, and that, people don't have a problem or are fine with the 401k communication, but when it comes to something new, they have different expectations, right? Well, what I've started doing, so if you go invest in a stock or your 401k or whatever, right, you don't have to sign a 90-page private placement memorandum that basically is, every risk in the world that could possibly go wrong, right? So I've started kind of explaining to people up front in our initial investor meetings, that's something that's coming down the pipe, because I think that for a lot of people, that's, the first thing that gives them reservation or pause, because like I said, you don't have to do that for most investments, but because we're selling, unregistered securities, in this case, then it's a requirement, right? And so I think if you can explain to potential investors early on that they're going to have to sign this document and what the risks are, and kind of joke about it, kind of like I am right now, and make it fun, then it helps to, one, helps to educate them about what the process is going to look like, but two, kind of helps to make that process a little bit easier, hopefully, as they go through it.
Yeah, and it's that's a good point, right? Education for any limited partner is key, and understanding the type of investment and then what to expect from the beginning of the process through funding the deal, and then communications while you're an investor in the project. But you just mentioned previously that you have moved some funds from your self-directed IRA, and I know that's a common conversation within the community, but a lot of people outside the real estate community are unaware that that is an avenue that they're able to explore. Like, I know I've moved several companies in my professional career, and I had old 401ks sitting in a fund that I've rolled over into Fidelity, but I can choose to also now roll over those into self-directed IRAs as well, and choose to invest that money into certain real estate projects. So I'm curious, how was that process for you? What did you learn from it? What hoops did you have to jump through to get that money moved? And curious to what custodian you chose to go through.
Yeah, so I decided to go with Advanta, and part of that's because they have a really good program in working with syndicators to help group and educate their investors. And so the gentleman who I work with, has been very helpful in talking with my investors when they need it. Because like you said, I mean, I think one of the most eye-opening conversations I have with most of my investors is that you can use your 401k, your IRAs, etc., and invest in real estate. Now, you don't have to use all of it. You can certainly would recommend still diversifying, but most people have a really big chunk, and some of it, sometimes you can only invest in your company stock, or you can only invest in 2 or 3 options, right? So now all of a sudden you give someone, explain to them that they can basically get control of their retirement or their financial future, or however you want to look at it. It's a really attractive opportunity for them. And so, educating them on that, and it's an incredibly simple process. I mean, literally all you have to do is, if you have a good financial advisor now, reach out to them, basically let them know you're going to be transferring funds, fill out a little, the same amount of paperwork you'd fill out to start a new brokerage account pretty much anywhere, and determine how much you want to transfer over, and then transfer it over. And then it's just a matter of finding the deal and working with the sponsor and your custodian. It takes a little bit longer, right? Because and you have to work with them to fill out the paperwork correctly when you actually find the investment that you want to do, right? Because you're no longer investing as Brian Heller or an LLC or whatever. You're now investing under the IRA, and there's weird is probably the wrong word, but there's specific language that needs to be used and things like that. But it's all pretty simple, and all you got to do is get on the phone with your people, and they'll walk you through, so you can fill everything out in the portal and stuff correctly. And they ultimately sign the paperwork versus you, and little things like that. So like they're going to send you requests for permission and things like that. But I would say overall, I mean, it's a pretty simple and straightforward process, and certainly no more difficult than, like I said, really signing up for a traditional brokerage account or anything like that.
It's amazing. So you kind of gone from blowing up mountains, traveling the world, investing as a limited partner, now as a general partner. What are your plans for the next 3 to 5 years?
Our goal is, to bring our investors hopefully 2 to 4 deals per year. I really feel like this is a time period where we're certainly much more towards the bottom of a cycle than the top of a cycle. So I'd really like to, the first cycle really was sort of an opportunity to learn the business from so many different angles. But this time around, I'd really like to put all that experience into action. And, my goal is to get somewhere between, 500 to 1,000 units as a GP in the next 5 years. We've got a strong team in place. So, 100 to 250 units per year, I think is a good number. Steady growth and scaling at a reasonable pace. So that's really what I'm trying to accomplish.
And what advice would you give to someone that is starting to look into investing in real estate, whether it would be for the first time, or whether it's the first time they're ultimately investing in a syndication as a limited?
Well, I'd say it's a marathon and not a sprint. Learn a market and a product type well before investing or putting your money into it. When you're talking about other people, I think, and investing in real estate, one of the most important decisions I think that most people have to make is if they want to be an active or a passive real estate investor. And I think that most people think that they want to be an active investor because that's what we see on HGTV or where most people start, right? They're like, oh, I'm going to buy a single family house. And then the first time they get a call at 3 a.m. that a pipe broke on Christmas, they realize this isn't too awesome, or that like you said in the beginning, finding the deal and financing the deal and dealing with the taxes and the accounting and the leasing, it's a lot of work. It's really is almost a second job, right? So this opportunity now to passively invest in real estate, has really opened up a lot of opportunities for people, and I think allows them to make a decision that is best suited for their lifestyle.
For sure, and that makes sense. And I want to piggyback off of that. So, if you could go back to the start of your real estate investing journey, what would you do differently?
I would start earlier. Like I said, I really wish that, my financial advisor had talked about it, from the beginning, but they don't. Live in a cheaper city. Living in LA for 18 years is also part of the reason why I didn't start earlier. And then I think two strategies that I talk to people about all the time, if you can, and if it makes sense for your lifestyle, is to either, buy a house when you're in college and then rent it to your friends. I mean, really, that's more likely your parents buying the house, but then, having 3 or 4 rooms and renting to all the other kids, for 3 years that, that you're potentially there. Because you probably got to live in the dorms your freshman year to make friends. And who knows, maybe you want to live in a fraternity house or something your sophomore year. But even if you could get a couple years, with it being fully rented, that can potentially work out well. And oftentimes people stay around in the city and stuff that they live in and things like that. So that's one great little trick. Another thing is, instead of renting, to go and buy a duplex and, live in one side and rent out the other side. So those are two things that, I think are good little tricks. I wish that I had the ability to do that, but, going back to LA, a duplex in LA could have been $1 million. And, same thing, buying even a single family house, near USC is pretty expensive as well. So, but, if you're there's a lot of college towns and a lot of, areas where these strategies would work, and they're great opportunities.
Again, like you said right at the
Definitely.
start, location. Understand completely, having lived in New York for over 8 years. It's, again, not a place that you can just go around buying duplexes. But one of the other things that you said right at the beginning of the conversation was that you wanted to have kind of more control of your life and schedule. So how do you balance the demands of running a successful investment firm with your personal life? I know you're a very avid golfer as well. So tell us a little bit about how you manage that as well.
Yeah, well, the good thing is you can find a lot of good investors on the golf course, right? So that helps. But I mean, the biggest thing I can say is I just, at this point, really try to block off my weekends for family and personal time. That's one of the main reasons I got out of brokerage as much as possible, because brokerage, you do kind of oftentimes have to work 7 days a week, especially if you're doing residential brokerage, even though I'm mostly doing commercial brokerage. But that's probably the best tip I can say is most thing, if it can wait till Monday most of the time, and otherwise just, real estate, things ebb and flow. When the iron's hot, strike and work as hard as you can. And, when interest rates are 9% and no one wants to do a transaction and no deals are going down, then, maybe you can hit the golf course a little bit more.
Great advice. No, I will never argue about hitting the golf course, and hopefully we can, when we're in Nashville, get out with you for a round. But in wrapping up, we want to thank you for your time today. You provided a ton of amazing value to not only us, but our listeners. So where can all the listeners go to find more about Fairway Equities, Brian Heller, and ultimately get in touch with you?
Yeah, the best place to go is just to go to my website, and that's www.fairwayequities.com. Certainly, I'm on Facebook and LinkedIn. We're about to start doing some monthly webinars, but all of that basically goes through the website. So like I said, if you just go to the fairwayequities.com, that's the best place to start, and you'll be able to access anything else you need to from there. We've got some free resources like an ebook and a due diligence checklist. But like I said, all the podcasts I've been on, there's some great blogs, and pretty soon going to be some webinars. So excited to get going on that, and looking forward to having a new deal here soon for all of our investors, and just keep on keeping on.
Amazing.
Thanks, Ryan.
Thanks again for your time.
Thank you for tuning in to the Peak Profits Podcast. We hope today's episode was not only inspiring, but packed with actionable insights for your passive real estate investments. Subscribe so you never miss an episode. And if you enjoyed the show, please leave us a review. Your feedback fuels our passion to bring you even more valuable content. Stay connected with us on social media and visit 7peakcapital.com for exclusive resources and updates. Until next time, keep striving towards your financial goals, and let's reach new peaks together.